What would happen if a war in the Middle East suddenly disrupted the global oil supply? The effects would not appear overnight, but within just a few weeks, the shock could begin spreading across the global economy. Much of the world's oil passes through a narrow waterway known as the Strait of Hormuz. If conflict threatened shipping there, the consequences could ripple through energy markets, global supply chains, and even everyday prices in countries like Canada. A disruption in one region can quickly spread across the world. Oil prices move, shipping slows down, transportation costs rise, and within weeks, the effects begin reaching households, businesses, and national economies. So how could a regional conflict trigger a global economic shock? To understand that, we need to look at how the impact unfolds over time, week by week. Before I go ahead and show you how, if you found this analysis useful, consider subscribing for more deep dives into global geopolitics. Every week we break down major global developments and explain how they could shape the world economy and international politics. In the first week of a conflict escalation, global markets react almost immediately. Investors begin responding to uncertainty. Energy traders start pricing in the possibility of supply disruptions. Even the perception of risk in the Persian Gulf can push oil prices upward within hours. Energy companies begin closely monitoring tanker movements and shipping routes through critical choke points. One of the most important of these routes is the Strait of Hormuz. Insurance costs for vessels entering the region increase as the risk of disruption becomes more difficult to predict. Some shipping companies may delay departures, others may reroute vessels until the situation becomes clearer. These early adjustments begin affecting the global flow of oil. For most consumers, the impact is not yet visible. Fuel prices at gas stations and everyday costs may remain unchanged for the moment. But in financial markets, the adjustment has already begun. Oil traders, shipping companies, and global investors are already preparing for possible disruption. But if the conflict continues into a second week, the disruptions begin spreading beyond financial markets and into the global supply chain. If the conflict continues into a second week, the situation begins affecting the physical movement of oil and goods. Shipping companies become more cautious about sending vessels into the Persian Gulf. Much of that caution centers around critical choke points, especially the Strait of Hormuz. Insurance premiums for tankers entering the region increase sharply as the risk of disruption grows. Some vessels may remain anchored outside the Gulf, waiting for safer conditions before continuing their journey. At the same time, any damage to energy infrastructure such as refineries or export terminals can begin tightening the global supply of oil. As supply becomes more uncertain, oil prices continue rising. Analysts often warn that prices could move past $110 per barrel. In more severe disruptions, prices could even reach $120 per barrel, depending on the scale of the conflict. At this stage, industries that rely heavily on transportation begin to feel the pressure. Airlines face rising fuel costs. Shipping companies increase freight rates. Manufacturers begin calculating how higher energy prices will affect production. But by the third week, the effects begin spreading far beyond the energy industry and into the everyday economy. By the third week, rising energy prices begin spreading into the broader economy. Transportation costs increase as trucking companies, shipping lines, and airlines pay more for fuel. Energy is involved in nearly every step of modern supply chains. As fuel costs rise, these higher expenses begin affecting many other industries. Food transportation becomes more expensive as trucks carry goods across long distances. Higher transport costs start pushing up the price of everyday products. Plastic production, which is derived from petroleum, also becomes more costly. This affects packaging, manufacturing, and many consumer goods. Even household energy expenses, including heating and electricity, may begin rising in some countries. Nations heavily dependent on imported oil feel these pressures most strongly. Higher global prices quickly translate into higher domestic costs. Governments may begin discussing the release of strategic petroleum reserves in an attempt to stabilize markets. At the same time, central banks begin monitoring inflation risks closely. Energy prices now influence major economic decisions around the world. What began as a regional conflict is now influencing economic decisions across the global economy. But if the conflict continues into a fourth week, the situation could escalate further, raising the possibility of a global energy crisis. If the conflict continues into a fourth week or longer, the situation could escalate into a genuine energy crisis. The most serious scenario would involve major disruption to shipping through the Strait of Hormuz. This narrow waterway connects the Persian Gulf to global energy markets. It is one of the most critical oil transit routes in the world. Every day, millions of barrels of crude oil pass through this passage on their way to major economies across Asia, Europe, and beyond. If shipping were blocked or severely restricted, a significant portion of global oil supply could temporarily disappear from international markets. In such scenarios, energy analysts sometimes warn that oil prices could surge dramatically. Prices could potentially reach $150 per barrel or even higher, depending on the severity of the disruption. For many countries, this would trigger emergency economic measures. Governments might release oil from their strategic reserves in an attempt to stabilize markets. Energy producers in other regions could attempt to increase production to offset the disruption. At the same time, diplomatic efforts would intensify as global leaders attempt to prevent further escalation. But even after the conflict ends, the economic shock could continue affecting markets and supply chains for months. Even countries located far from the Middle East are not immune to the effects of energy disruptions. Because oil is traded on a global market, price increases in one region can quickly affect economies around the world. In Canada, higher global oil prices often appear first at the gas pump. Drivers in major cities such as Toronto or Vancouver may begin noticing rising fuel prices within days. As global markets react, businesses that rely on transportation begin facing higher fuel costs. Moving goods across the country becomes more expensive. Those higher costs eventually reach consumers through rising prices for groceries, household products, and everyday essentials. At the same time, Canada is also one of the world's major energy producers. Much of the country's oil comes from the oil sands in Alberta. Large-scale extraction projects in Alberta supply crude oil to both North American and global markets. When global oil prices rise, the Canadian energy sector can benefit through higher revenues and increased investment. But for most households, the immediate effect is felt through higher transportation costs and a gradual rise in the overall cost of living. This is why conflicts that threaten global energy supplies are closely watched, not only in oil-producing regions, but across economies around the world. And this is why energy infrastructure and global shipping routes have become such critical targets in modern conflicts. The targeting of oil infrastructure during conflicts sends a powerful signal about the nature of modern warfare. Energy is the backbone of the global economy. Industries, transportation networks, and entire national economies depend on a steady supply of oil and fuel. That is why strategic locations such as the Strait of Hormuz carry enormous geopolitical importance. When conflict threatens these routes, the consequences extend far beyond the battlefield. Financial markets react, supply chains slow down, inflation spreads through the global economy. What begins as a regional conflict can quickly become an international economic shock. And this is why governments, businesses, and energy markets around the world watch these developments so closely. Because in today's interconnected world, the struggle over energy infrastructure is not just about military power. It is about economic influence, global stability, and the balance of power in the international system. Because sometimes the most powerful battles in geopolitics are not fought over territory, but over the flow of energy that powers the world. If you found this analysis useful, consider subscribing for more deep dives into global geopolitics and the forces shaping our world. Every week we break down major global developments and explain how they could shape the world economy and international politics.